Hello and welcome to Biogas TV, the number one live streaming TV show in the world for the biogas business. I'm Paul Green. I run an RNG advisory business. I'm very pleased to be here with my co-hosts, Alex McFarland of RNG Connect and Drew Puchot, who drives our offtake roundup piece. Today's episode is sponsored by IVUS Adsorption. IVUS is the market leader in fast cycle PSA upgraders. Their BioStream packaged gas upgrader hits a 300 SCFM sweet spot for a fully plug and play system. Check them out at ivysads.com, ivysads.com. RNG offtake continues to boggle the industry. Finding a good deal at a fair price is increasingly challenging. Today, we wrap up our series of presenters in the Canadian CFR as a possible place to send RNG with Anna Abramovich. Anna has 20 years in trading and origin across power, carbon, and clean fuel markets and specializes in Canadian compliance carbon, clean fuel regulations, and the voluntary carbon market. She structures solutions aligning economics, regulatory requirements, and corporate climate goals across North America. She works with Clear Sky Limited, a global environmental markets platform focused on sales and trading, development advisory, and investments. They deliver high-integrity carbon projects across nature-based solutions, permanent removals, plastics, and compliance markets for corporates and investors. So Anna, welcome to Biogas TV.
Thank you. Thanks for having me.
We're so pleased to have you with us and to help us sell our RNG across north of the border.
Excellent.
So we had a little agenda we set up. So as far as getting the ball rolling, we're going to talk about some of the realities of doing a CFR deal, but do you want to just kind of get us going, Anna?
Sure. I'm just gonna share my screen. Does that look okay for everybody?
It's coming up.
Okay, great.
Yes, we're good. Yep.
Yep.
Technology hasn't failed us yet, so that's good. So like Paul mentioned, I worked at Clear Sky and we've been working on and chatting about cross-border RNG participation in Canada's clean fuel regulation, the CFR regulation, and what that could maybe look like for RNG developers in the US and bringing their RNG to Canada. This is about Clear Sky. Paul already mentioned a bit of it. I'll go to this slide where really it's about us being an integrated platform. I like to think of it as a three-legged tripod. We have the credit sales and trading, which is the tripod I sit on, the part of the leg, where we're helping monetize, credits of different, I guess, different environmental attributes, as well as sometimes molecule plus the attribute, to voluntary compliance markets across the world. And my focus often is on compliance programs in Canada. I live in Canada. Then we have the tech advisory and project development arm, which provides advisory services to project developers and actually gets them to the credit creation aspect of the project. So sometimes project developers require just a little bit of support in a certain aspect of their project to issuance pathway, and sometimes they require a lot more support. So any kind of combination, the team on the advisory side sits there and provides that support across voluntary and compliance markets, tech, CDR, VCM, nature-based solutions, and then also RNG as well. And then we have the investment and fund management side, which is the financing side where we're co-investing and maybe deploying some capital in certain carbon projects to really help them in that initial stage of the project to get them off the ground. And so we kind of think of ourselves as this comprehensive platform solution. So if we were to think about it from a CFR angle, And I don't know if a lot of people know what CFR is, so maybe I'll do that first. I'll just talk about what is clean fuels regulation in Canada. So in Canada, we have a federal national program that's administered by ECCC, Environment and Climate Change Canada, to reduce carbon intensity of fuels used in Canada in transportation. So people who sell diesel and gasoline in Canada have an obligation. They're called primary suppliers, and then you have different clean fuels that are able to create credits. RNG is one of those pathways that can create credits under the CFR. Um, and it's really based on your carbon intensity against the benchmark. So depending on how many credits you can make from that. And for me, the clean fuel regulation, I think, Canada is a energy superpower in the world, and we are a large oil and gas producer in the world. And I really do think that we have strong um, environmental and regulatory and legal precedents in this country in terms of those industries. And so it makes sense to me that oil and gas would transition, or it's like a natural transition, I think, to incorporate clean fuels in their current infrastructure and operations versus, even electrifying everything. I think well, in my mind, is just not realistic, firstly. And I did spend most of my career in power. I think we have such a high energy need for all energy that we're going to have to be really developing all different types of energy and making it work in unison and symphony. But for oil and gas, it seems like a natural progression to incorporate more clean fuels. I also think that it's a really great support for agriculture when it comes to clean fuels. So there's a second benefit, I think, for the country and for the US as well. So the clean fuel regulation, you're able to, as an RNG developer, think of it as a new compliance credit revenue streams. So if you're trying to diversify beyond US RINs and LCFS markets, and really you can even allocate a partial volume into the market and take that to Canada. Or I suppose you could take all of it if you wanted to, if it's a project that has an FID yet and you're kind of trying to get there, and this might help you get your project commission. So when it comes to CFR, I was trying to summarize this, Paul, into 5 buckets. There's a lot of sub buckets under the 5 buckets, but really, if I were to think about what my colleagues in the advisory and technical development team side would do, is the first 4 buckets, and I sit on the fifth bucket. But really, to get started, they would really need to do a project screening with the developers. So you have to identify the fuel time, project data review, and do a pathway assessment and see, would your CI under the CFR actually be lower than the benchmark CFR so that you can be a credit creator? And then register with ECCC, complete a fuel LCA model, and apply for that pathway application. Then you would start actually doing the independent verification once you're producing and being able to submit actual data to verify that CI and get independently verified for it. And then you have an ongoing review and annual reporting requirement, and those credits get issued. So for RNG, there's 3 different credit types under CFR. There's category 1, 2, and 3. And category 2 is subdivided into liquids and gaseous credits. So RNG falls under category 2 gaseous. There's also a pathway to create category 3 credits with RNG, but I think in this instance, I'd like to focus on talking about category 2 gaseous credits. And so when you create those, or what's special about those, is that there is a limit to how many credits from CC2Gs you can use for your compliance obligation. There's a 10% limit. So if you're trading California cap and trade, there's a CCO limit in terms of percentage. In Quebec cap and trade, that's the same thing. Offsets can only be used for a certain percentage. That's kind of the same pattern that category 2 gaseous credits follow under Canadian fuel regulation, is that you can only use them for 10% of your obligation. and they get issued on a quarterly basis. So category twos get issued on a quarterly basis, and category one and three get issued on an annual basis. So every quarter you would get your tranche of credits. Once you verified and set up an ECCC and so on and so forth, or your credit creator and you're creating these credits, you would get a new tranche of quarterly credits and could transact those. Or you could, obviously sell them in an offtake
So,
and not use them for
couple of questions here, Anna. Thanks for the overview. So I see from the US standpoint, we've got this cross-border, Canadian registered entity, cross-border chain of custody, and enhanced ECCC review.
Mhm.
The Canadian registered entity, I would assume that means that, you have an entity that is a registered credit creator at some part of this transaction, right? So if you're
Yeah,
US, you
so
would be a foreign supplier.
yeah.
Um, you
Well,
know,
so US counterparties, or I guess fuels developers, fuels producers, clean fuels producers, could go and get qualified as a credit creator under the clean fuel regulation themselves,
okay.
um, rather than really selling it at the border. And then somebody else who's, let's say, the primary supplier who's buying the offtake, it just picks it up at the border. You could go through the process of actually getting set up as a credit creator. Um,
So in that case, you would just be trading the credit. You would still need to bring the gas, right? You still need to transact the gas into Canada in that case, but you could trade the credit directly.
that's right.
Got it. And then enhanced ECCC review. Are we seeing U.S. developers and projects getting a closer inspection from ECCC?
That would be more of a Bobby question than an Anna question. I just think that you really have to, I think you really have to show your data and your supply chain to prove it out,
Yep.
and to get it verified. So I think that they just take a closer look.
Thanks.
Yeah. So then when it comes to the trading and, transferring the credits under the account, which is called CATS. So you can sell your credits as part of an offtake for RNG, both the molecule and the credit, the category two gaseous credit. You could hold a portion of it. Maybe you're already a developer that has developed their project and you don't need to sell the molecule into Canada. Well, you have to sell it into Canada to make CFR credits, but you don't have to sell it as an offtake, perhaps, because your project has already been built, and you don't need that for project financing. Then, if you have some portion of those credits, if 100% of them is not attributed to the offtake, you could sell those in market, um, on the spot market.
Okay.
Do you have any questions?
Yeah, yeah. Okay. So this is the general overview of how
Yeah.
the market is working. You mentioned this 10% cap, and as we've talked about this before, this cap number has come up. Um, if I understand it correctly, this means that the primary suppliers um, can purchase these CC2G credits,
That's right.
but only for 10% of their total emissions obligation or emissions reductions obligations.
That's correct.
So the rest of it they would have to get by buying either like blending with biofuels or doing efficiency measures at the refinery or carbon capture or something else. Is that how I
Or
get it?
or buy almost fully, yes, but or buying other category credits in market. So other category
Right.
credits in market do not have a limit of 10%. Um, just the category two Gs do. I know there's been, there's always chats about, oh, will they increase the 10% to a higher percentage? Um, that hasn't come through in the regulation at all. So maybe at some point that will happen, but not yet. I think we still don't even have enough RNG credits in market to warrant that, perhaps, but maybe that would,
Yeah, I think that at least at this point, they're probably well below that 10% is what I've been hearing.
yeah,
Probably between 1 and 3 somewhere.
Mhm.
yeah, that's what I.
Um, but the idea is, or the expectation is that this is mostly a paper transaction, right? That's especially if you're existing producers of RNG. So the expectation is that 10% will get filled as the more pathways get approved. We'll see though.
Right.
Well, it's a big question about what the CI scores of those
Yes,
pathways that get approved are.
Aha,
Those
yes, good
come up
point,
as
Drew.
well.
that's
Yep.
right.
Now, another thing, and I'm curious, Anna, yeah, from your perspective, and feel free to refrain from sharing if you want. Um, there's gaseous credits and there are liquid credits,
Yes,
and both of them effectively have somewhat of a cap because there's a 10% cap on gaseous credits, but there's I guess a better word for it being bottleneck on liquid credits for RNG because you're limited by how much you can actually dispense. Whereas, you know,
Isn't that
ethanol,
category 3?
I think that that falls under category three for RNG. For category two liquids, it's more like biodiesel, renewable diesel, ethanol.
well, my point being is that if you're trying to generate liquid credits using RNG, you're
Yeah,
still
category three
bottlenecked
liquid.
by,
Yes, that's right.
yeah. And
Yeah,
so, uh, regardless of not wasn't distinguishing based on the credit type in terms of CC2s or CC3s. I just was focusing on the amount of volume that there
distribution.
is for dispensing RNG in
Yeah,
Canada, which is significantly lower than it is here in the US or even specifically California.
that's right.
Um, and so I think that's an important consideration as we hear about these prices in this market. And I've also had a lot of people who've said, well, how can credits trade above this cap that I keep hearing about
Right.
if, why is the price going above the cap?
Right. So I think that's a really good question, Drew. I think what people don't realize, and I didn't realize this either. So in Canadian OBPS, so carbon compliance markets, you have a headline price, and that really is effectively the highest cost of your compliance obligation. So let's say for 2025, the carbon OBPS headline price is $95 a ton. So an obligated party could just pay their total emissions obligation at that $95 price. And so that would be their maximum cost of obligation. Or they can buy in-market credits at a cheaper price and save on their obligation that way. However, under CFR, you don't have the option to procure your entire obligation at the fund price. There's a couple of different mechanisms, but really the one that major primary suppliers would be utilizing is the ERFP fund. And you can only put in 10% of your total obligation um, into an ERFP fund and then get virtual credits in return to meet 10% of your compliance obligation. So the vast majority of your compliance obligation, if you're a primary supplier under the CFR, is through either blending or purchasing credits in market. So then it just becomes, and maybe why CFR is my favorite compliance market in Canada is just it feels more like a traditional commodity where there's more supply demand taking place because there is not that headline price that you can pay for your 100% of your compliance obligation.
Right. And also, if there isn't, it's interesting because if there's not enough supply, right? If the credits are not cheap enough, the temptation or that you would think that the primary suppliers just buy the credits, right? Or buy compliance, which is effectively just a tax, right? It's effectively a carbon tax. And it's not necessarily directly decarbonizing the fuel. So when
Hmm.
you can only do a certain
Well,
amount at a certain level, wouldn't you say that, or if you can only do so much via this,
there's two requirements under the clean fuel
yeah,
regulation. One is to reduce your emissions, and the other one is a volumetric requirement. So there
okay.
are also rules around volumetric requirements in terms of lowering the CI of your fuels.
There's a lot of factors at play. It goes into that supply and demand on these credits. And so
Yes.
that was kind of what I was trying to touch on as well is,
Yes.
it's not as simple as, uh, how many credits are we generating and how many credits are we using?
Two,
and so on and so forth.
two questions have come in. Do you need to physically move gas from US to Canada, or can you mass balance? And the second one is, are credits bankable?
Yeah, so you can book and claim. So you do need to move it to Canada, but you can book and claim credits. And yes, they are bankable, so you could hold them in your inventory. So also, I guess maybe what's a little bit different than traditionally in carbon credits, usually when a vintage of so the year that the credit was minted, the vintage of the credit, if it's in carbon, it seems to be the older that vintage is. So further away from today's date that it was minted. So it was like vintage 21, vintage 22. It decreases in value the older it is. In CFR, you can only use vintages that are up to the year of that compliance obligation. So for 2025 compliance, you can only use vintage 25 or older. So 24, 23, 22, 21. Well, 22, I guess, 23. When did the CFR start? 23. So the older credits actually don't lose value because you're able to use them for any future year's compliance. But if you were to mint vintage 26 credits, let's say with your Q1 RNG facility for 2026, those ones cannot be used for 2025 compliance. Those would then need to be, if a primary supplier bought them for their compliance, they would have to use it towards their compliance year 2026.
Well, that should have the effect of making the older credits actually more valuable if you assume that supply is growing over time, potentially. Who knows?
Well, I think really as soon as so I think for vintage 25 or older credits right now, there probably is a bit of a discrepancy in pricing because
Yeah.
those ones can be used for this year's compliance or for 2025 year's compliance compared to vintage 26 or forward vintage 27, 28 for
Yeah.
sure.
I mean,
But
this is classic.
as soon as you
Sorry.
get into as soon as you get into the compliance year, then that year's compliance credit is just as worthy as the earlier or the older vintages. It doesn't really have more value or less value.
I'm always trying to be optimistic as a biogas guy. You're always looking for the upside.
Yeah.
Yeah.
That's right. It doesn't lose value. So that's the upside is even if if your credits are, vintage 24, it does not mean that your credits are losing value because they're aging.
So, some crystal ball time here, Anna. So, one thing that we've heard in our conversations, and I think you mentioned talking with some of these primary suppliers who have an obligation, they're
Mhm.
not ready to sign up, or they're not signing up for long-term obligations. This is what we've been hearing, or long-term agreements, meaning 5 to 10 year terms. And what I've heard is that essentially they believe that there's some stroke of pen risk with a change of a change of administrations in the
Mhm.
future.
Yeah.
So but at the same time, this seems like it's really well integrated into Canada's economy, or it will be, right? More and more so. So what would you say here? And what are the chances that is there stroke of pen risk? How can we size that up? Or is it just the oil companies basically saying like, la la la, I don't want this isn't real.
Um, well, I think, I understand why there has been hesitation and there's risk attributed to signing a longer term offtake. At our last federal election, there was a strong chance that Pierre Poilievre was going to be elected, and he really ran on canceling CFR. Well, I mean, canceling the carbon tax overall, but he also did speak about canceling CFR. And so I think that really kind of made everybody nervous about what to even do about CFR capital, especially whenever you have uncertainty. Capital is stuck and does not know what to do, or finds other places to deploy their capital where there's not that uncertainty. So maybe some of the reasons why we're having these higher prices is because during those initial years of CFR, there was so much uncertainty if the program would still be there, that capital did not deploy to build new infrastructure and credit creation opportunities even within Canada. As Carney got elected, I think now people in the short to medium-ish term are CFR is here to stay. Do I think that there's risk of CFR being eliminated if a conservative government is elected instead of a liberal one? I guess there's always some risk. I feel like it's less risk than it used to be. And maybe this is, I'm drinking my own Kool-Aid and thinking about this now through the CFR lens. But I really do think, and I know we're talking to the US RNG producers today, but they can probably relate to this in the US as well. I really do think farmers are the solution and that it really comes down to farmers. And so if I think about Canadian farmers who have been hit hard by geopolitical events that are happening, tariffs, not just from the US, but also internationally that are impacting them, I think CFR is a pathway towards a resilient revenue stream for our farmers and our agriculture industry. And so I think that governments are starting to understand that and think of it that way as well. Um, in Alberta recently, there was an RNG project that got announced, Taurus RNG in Coaldale, Alberta, southern Alberta. We have a lot of agriculture, and it's really integrated with the farm there. And the provincial government was there at the announcement, and they got some money also from the ERA. So I feel like people are starting to understand that clean fuels are very integrated with agriculture. And so you do get an addition to having this program in that your agriculture sector can benefit from it. And I think it's real money for the farmers. So to me, how CFR stays sticky and does not have that risk of elimination, depending on who's elected, is that we really need to talk about how does it benefit the farmer and the agriculture sector.
Well, it works for RINs in the US, that's for
Yeah,
sure.
exactly.
Well, really quick though, to kind of expand on that a bit more, and especially because somebody asked, is there any geopolitical risk for US RNG going into Canada? There has been some conversations about uh, putting a domestic supply requirement or a credit
Bonus.
multiplier
Multiplier.
on
Yes.
Canadian produced projects.
Mhm.
What are your thoughts on that?
Yeah, so ECCC had asked for comments and people have submitted comments. I anticipate that sometime in 2027 they'll start. Well, I don't know. I don't know if any of that will really be in place and actually like as they go through their process. I don't know how quickly that will happen. My anticipation is that it won't really be implemented until at least the second half of 27, maybe even first half of 28. But yes, so there are different ways that they're thinking about it, either through having a domestic feedstock requirement um, for the blending or giving a multiplier to Canadian created credits. I suppose that is a risk to the US RNG in that maybe you won't get um, the same price, or maybe won't be getting as many credits, so not the same value as a Canadian RNG program, but it doesn't mean that you're eliminated from participating in it.
Mm.
I think it's just because we haven't built out our infrastructure and we're very dependent on the US and international clean fuels in coming into Canada, that's really there to try to kind of bring more attention and maybe bring more capital to build out that infrastructure in Canada.
So the message for the US
Awesome.
biogas developers is go build plants in Canada too, right?
That is correct, yes.
Cool.
We'd love that. More
We're getting
jobs.
close to time. Anything else we want to hit before we call it?
We got to have Drew's roundup.
Let's do a quick touch on this because we're seeing that there's more demand coming in for offtake, term offtake, both in landfill gas and low CI RNG, starting in 2028.
Mhm.
Working on what that looks like. So happy to chat with anyone that's got projects that could be coming online. Also looking for some low CI RNG to deliver into California. And I think this is going to be really a big consideration in terms of, where does pricing and low CI demand go with the developing markets that we're seeing between Canada, New Mexico. We saw New Mexico trade last week, $150 US per ton. They've got, I believe, a 270 cap. Uh, we're still seeing it 125 bid. We're seeing Oregon trading or offered rather around 182. So as these markets develop, it's going to be interesting to see whether or not they create some shifts in interest and RNG moving from California out to New Mexico, Oregon, Canada, and so on.
Cool. Well, great. So that's the show. If you go to biogas.tv, you'll find some previous recordings we did on the CFR. Fortis BC spent a half hour with us, as well as Mittal Monani. He spent some time with us. So our recording bank is growing. This will be up for your download on Biogas TV shortly. Next week, we've got, with diesel now being well over $5 a gallon, the thought of converting liquid fuel vehicles to CNG is as popular as ever. So we're going to talk about vehicle conversions from liquid to CNG as some other stuff next week. So with that, we'll wish everybody a good week. Drew, Alex, we'll see you guys. Anna, thank you for hanging out with us. This is wonderful.
Thank you for having me. It's always fun to chat CFR.
Good.
Thanks,
All right,
Anna.
Thank you.
everybody.